Welcome to the Broken Pie Chart Podcast, episode 172. I'm your host, Derek Moore. This week we're going to be talking about, is this the second iteration of the Dotcom bubble bursting? Had a couple conversations recently, and I was talking to one person there saying, I don't think this is the another .com bubble, and someone was trying to convince him that it was. And so that's kind of what I'm going to start with. I'm also going to talk a little bit about, looks like Tesla is splitting 3 for 1. We just had an Amazon split 20 for 1. Do these even matter? And so anyway, let's talk about the .com era. And I pulled up, and I very rarely talk about just individual companies and individual company earnings and revenues and all that type of stuff. And longtime listeners know that obviously I'm a big proponent of buying and hedging or buffering, and so you've got some wiggle room with markets. You can reach out to me at derek.moore at zegafinancial.com. That's derek.moore at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Financial's up to you to spell correctly.com. And I'm happy to go through how we build portfolios and how we hedge and manage risk. But so this question about, and by the way, I keep saying this, if we do get a recession, it would be the most telegraphed recession ever. I mean, everywhere you go, you're looking at articles, you're watching CNBC, and you're seeing people talk about, well, the probability of recession is higher. But obviously the market's in a drawdown. S&P year to date, the total return, I think, is just over minus 17%. Of course, I think we went up, 39% 2 years ago, or last year. We went up 18% in 2020. And so, these types of moves, sort of this flushing out, happen. But thinking back to March 31st of 2000, and I'm going to use the Nasdaq 100 index, or the QQQs is the ETF that invest in the companies in the index. And I'm going to ask you a question. Can you name not only the company but the weighting of the number one company in the Qs in March, end of March of 2000? This is the Nasdaq 100. Now think about it for a second, and I'll give you a hint. Apple is not even in the top 10. You'll never get it. And the reason why you won't get it is it's Sirius Satellite Radio. Sirius Satellite Radio. They were the number one weighted company in the Qs or the Nasdaq 100 at the end of March of 2000. And I had written an article, I think it was back in 2014 or 2015. I forget when. And it's not even up on our site anymore. Otherwise, I'd link to it. We had some of those very old articles didn't make it over, and we transitioned. But it's I reached out to the group that manages the Qs, and I asked them. I said, "Can you pull the weighting of the companies in March of 2000?" And they were able to do it. They sent me a list. So you look at this and you say, wait a second, Sirius Satellite? And to give you some perspective on this, if I pull up a graph of, let's say, Sirius Satellite, and now it's, of course, Sirius XM, and you look at their stock price, and they were over $60 a share in March of 2000. They were $3.59 in September of 2001. I mean, think about that. In 2008, they were 26 cents. Now, I actually hadn't looked at this stock in a long time, and I was surprised. They're actually $6.10. It's not a stock that I follow. So anyway, Sirius Satellite, the number one company in March of 2000. I pulled up, and you can go to the archives. It's a little bit difficult, if you don't have a system that lets you, pull up, go back further when you're thinking about, earnings reports and 10Ks and things like that. But Edgar is a site, EDGAR. You can type in a company name and you can go back. Sometimes you get lucky and you can find everything. Sometimes you can't. We can find quarterly reports and annual reports. But I went back and I pulled it, and apparently I'm just looking at Q1 of 2000, they lost about $43 million. And I couldn't actually find the full year 1999. But it is interesting. So you think about, Q1 of 2000, and I know the older I get, the more people that I talk to on this podcast and just in general don't remember the tech crash. Somebody who was born in 2000 is now 22. But I also looked, and it was interesting. In that report, there was a line that said cumulative net income from inception. The company was incepted May of 1990, and this was through March of 2000. On a cumulative basis, that's 10 years, they lost $304 million. Now, it's not uncommon for companies when they're brand new to run a net loss. And let's face it, Sirius Satellite, imagine they had to launch some satellites into orbit. That can't be cheap. But that was the number one weighted company in the NASDAQ 100, 9.5%. I'll give you an example. Today, as of June 9th, Apple is 12.33%. Apple probably pulled in $100 billion in net income last year. So I'll go through these quick. Microsoft is the only company, by the way, that is there today. Microsoft is number 2 today. They were number 2, actually, in March of 2000, which is interesting. That company has sort of had the staying power. Although I will say, after the tech crash in 2000, that stock went nowhere for a decade. And then, obviously, recently, depending upon the day, it's one of the highest market cap in the world. But then you had Cisco, Level 3, Qualcomm, Intel Corporation, which is obviously still around, but they're having some issues of late. It's not a stock individually I follow. Oracle, Broadcom, Sun Microsystems, and Yahoo. Yahoo was number 10. Yahoo is no longer in existence, right? I mean, I think that's been bought and sold a few times. I pulled up Broadcom's earnings, by the way. They made $83 million in 1999. They lost $687 million in 2000. Broadcom was, what did I say they were? They were like the 7th, somewhere around there, or 8th, 3.15%. Today, it's Apple, Microsoft, Google, Amazon, Tesla, Facebook, NVIDIA, Broadcom. Oh, Broadcom is in there again. There we go. The Broadcom pulled over. That's the second one. Pepsi, Costco. And, in March of 2000, those companies made up close to 60%. Today, about 53.5%. But I bring this up, is today a repeat of the tech crash of 2000? And I would say no. And the reason I would say no is part of, these companies, and I'm not saying you should go out and buy these companies, sell the companies. I don't do individual stock analysis. I know how to do it, but when you really do stock analyzing, like the people who actually do this, you're making judgments and you're making predictions and assumptions about the future. I mean, anyone can, I shouldn't say anyone, but a lot of people can just pull in all the readily available analyst data and the financials and plug it into a discounted cash flow analysis. But if you're really doing this, you have to make decisions about the future on these companies, about market share, taking market share, about currency risk, about, especially if they're international, what are their revenues going to be from all these different countries. But I would just say that the companies on this list today, all of them have earnings. And I think back then, the market was something like 100 times forward. It was trading at 100 forward PE. I looked it up the other day, and I think the Nasdaq 100 is something like 19 times forward. The S&P is 16 and a half. And so it's kind of interesting. I had forgotten I wrote the article, but I was in a conversation with someone, and we're talking about this. And yeah, I mean, Sirius Satellite Company. By the way, Sirius, I was like, are they making money now? And they are. And it's not a stock that I followed for a long time, but they are. They have a 17.7 PE ratio, and their market cap is $24 billion. They pay a dividend now, I suppose. And if you look at, I guess it's SIRI is still the symbol, and you pull up some of their financials. I mean, yeah. I have no idea what this stock is going to do. I mean, it's, but I look at their sales are, 5 to 7 billion over the last couple of years. And their earnings per share, I mean, their net income is anywhere from 647 million to 1.8 billion, or 1.18 billion. And their earnings per share is like 14 cents, 26 cents, 20 cents. Anyway, it doesn't matter. It's not a podcast about Sirius. I was just curious. So I would say that unlike the .com era, I think these are companies that they have real earnings. And back then in 2000, a lot of the prices were predicated on future earnings, the expectation that earnings were going to grow. And Broadcom's interesting because, and I didn't pick that up the first time that both of those were on the list. So Microsoft and Broadcom. And I pulled up an archived article from 1999, and Q4, they were saying, revenue grew 100% year over year. They were talking, they were really, really excited. Broadcom, it probably took them. I'm going to look this up right here. But Broadcom, when you look at how long it took that stock to recover, I can't go back that far. Anyway, so I bring this up, and I think it's just one of those things that gives you perspective. And it gives you perspective because, look, I've said again and again, the market goes where it goes. Price, buyers and sellers, momentum. If you have more buyers than sellers, stocks go up. If you have more sellers than buyers, stocks go down. And the fundamentals are the backbone of this. The fundamentals to help you understand, what's going on with the companies. But as I've always pointed out too, that if you look at a company like Apple, their cash flows, their earnings don't, oscillate 50% within a year, but yet their stock price can. And so price is the ultimate arbiter, and stocks can get overvalued, undervalued over time. But anyway, I would just say it's not a situation. It's not similar to the .com era. Recently, Amazon split 20-for-1. Tesla split, filed in some of their documents. I don't know if it's been announced, but they put something that a 3-for-1 split. And somebody asked me, he said, well, that should be really good for the stock. Here's the thing with stock splits. Technically, they don't matter one bit. Do not matter. Here's why they don't matter. Let's say a company has 1 million shares outstanding and makes $1 million in net income. You make $1 per share in earnings. Okay, fantastic. Let's say they're trading at $10, which would be 10 times PE ratio. It's trading at $10 per share, 10 times, right? So stock announces a 2-for-1 split. All right, awesome. So now you have that same net income of $1 million, but now instead of having 1 million shares, you have 2 million shares. Your earnings per share are now 50 cents per share. the stock is trading at, it was trading at $10, but now it's a 2-for-1 and split adjusted. It's trading at $5. All right. It's still trading at 10 times earnings, 50 cents earnings per share, stock price of $5. And people will say, well, wait a second. Companies tend to go up after a split. And I think there's been some data on this. And generally that's true. I think more often than not, the degree of which they go up is debatable. But I have seen some research on this. And here's sort of the contrarian view on this. In order for a stock to split, it has to have gone up already. Like, think about it. Stocks that are going down, 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 or not going anywhere, you don't really see splits. And I would say we used to see a lot more splits in certainly the 90s. You saw, I feel like, and I actually would have to research this, but I feel like we saw many more splits back then. You know, Amazon split 20-for-1. It's trading a little over $100 now. That was the first time it split. Google hadn't split, and then they did. Apple has had splits. Tesla's had splits before. Microsoft certainly has had splits. But, you know, Google and Amazon were the companies that actually had never split until they did. And I think it was okay to have, you know, a really high stock price. Remember, in the past, when you had commissions, the idea was, well, if our stock's at $200, wouldn't we rather, you know, or $1,000, the small investor wouldn't be able, you know, they're not going to be able to buy, like, maybe they can buy a share, but if they only have $500, they can't buy a full share. And so the idea was you split it, and then more investors could access the stock and things like that. That was no longer the case, especially as trading fees came down, and now we have zero trading fees. And now companies like Schwab, they have fractional shares. I think IB does it, Fidelity does it. Another bunch of the brokerage firms do it now. Meaning you don't even have to buy a full share. You can buy, you know, 0.10 of it, 1/10 of a share. And guess what? It's no commission. So splits really don't matter. And I think it's just coincidental when a lot of people think, well, if they split, that means it's going to go up. I think in order to split, and I believe you get where I'm going here, the stock already had to have gone up. And I also think in the case of, you know, Amazon and maybe some of the others that split after never splitting, I mean, I don't know if that helps their stock price or not. But the other thing that's kind of interesting about this, and I was just thinking today a little bit, and we just went through, you know, the NASDAQ 100 and the highest weighted companies. The S&P 500 index and the NASDAQ 100, those are market cap weighted indices. All right, what does that mean? Well, what it means is basically the highest weighting of a company is the highest market cap. So you take the shares outstanding times the price. So if you have, you know, like Apple's 3 trillion, I think there were 3 trillion or 2 trillion. It doesn't matter. But the highest weighted companies, meaning the weighting is number of shares times the price, that's your market cap. It's weighted from highest weighted, highest market cap, all the way down. The Dow Jones, though, does it differently. And this is where I was going with this. The Dow Jones is a price-weighted index. There's only 30 companies in there. And it's part of the reason why, especially over the last decade, I think, most people, when they think about the market, when they say the market was up or down, they're talking about the S&P 500. They're not talking about the Dow. Dow's only 30 companies. And it is price-weighted. And so if we look at, let's say, if I'm pulling this up, I don't know when this is from, Yeah, this is from this week. So United Healthcare is just under 10%. Their stock price closed at 44.63. They're the highest weighted Dow stock. Goldman Sachs is number 2 at about 6.2%. They're at 287. If I look in here, though, and you say, wait a second, isn't Apple in the Dow? They are. They are only the 16th weighted company. I'm like, wait a second. They're the highest market cap in the world, number one, the highest weighting of the Nasdaq 100 and the S&P 500. They're only 2.9% here. And the reason why that is, their stock price is 137. So the thing I was thinking of is, I wonder if now that Amazon has split, whether they eventually will get into the Dow Jones. Because if you put them in the Dow Jones with a, pre-split, what were they, $2,100 or something like that? Their weighting would be so skewed to the upside. They would have a gargantuan weight within the Dow Jones. So it's just something to I don't know if it means anything if they get in there or they don't get in there. Again, the S&P 500 is a bigger deal if you get in there. You remember the story about Tesla when they got in. A lot of people were waiting for that. And to get in, they got to kick somebody out. So I don't know. I'm looking at this list here. Does Intel get kicked out? Intel's had, a little bit of a rough go of it lately. I don't know what the stock's going to do. I don't follow it individually. But they have the lowest weighting. They are 0.81%. Their stock price was $39.24. And yeah, I don't know. Just something to keep an eye on. And I wonder if they did that, thinking maybe, I actually don't even know if they care if they get into the Dow. I haven't read up enough about, why they did the stock split, why they didn't. Sometimes people do stock splits. And I think this was noted in the Tesla filing, because employees have options. So let's say you're an Amazon employee and you have, 10 stock options and the stock's at 2,000. So you got $20,000 worth of stock options. At least that's, depending upon what your cost basis is. But let's say you had a zero cost basis on these, or you had, $1,000 cost basis. Let's use that. So if you sold those 10 shares, you would net $10,000 there. And of course, I don't want to get into the taxes of it, but that's. So one of the reasons I think that was noted in the Tesla thing was that they feel like employees with stock options and I'll use the Amazon example. So if you split it and it goes from, a 20 for 1, well, now you don't have 10 shares. What do you have? Okay. Well, that's simple. It's 20 times 10. You have 200 shares. And the 200 shares are a little over $100. So now if you needed a little bit of cash, you might be able to, Anyway, that's maybe one of the reasons. Neither here, it doesn't matter though. But I hope going through the stock splits, they don't matter. They really don't. A lot of times the companies were already going up. And then is this the Dotcom era? Is this Dotcom part 2 because of the tech stocks? I would just say, these companies have a lot more revenue, a lot more net income. We never know what's going to happen with stocks. I have no clue. I'm not saying to buy these. What I'm saying is back then it was trading 100 times forward earnings. Last time I checked, we're about 19 times forward earnings. If I knew tomorrow's prices today, that would be really helpful. We don't know those, but I would hazard to guess not a repeat of the .com era. All right, folks, that's going to be it for this week. Thanks for listening. If you want to reach out and give a suggestion for a future episode, it's derek.moore at zegafinancial.com. Also, lot of people have been asking for more, let's say, info or about inflation. Inflation is the hot topic right now. I skipped it for this one. Maybe we'll cover that next week. And but do email. I like getting emails. I like getting suggestions for episodes. And the thing about the stock splits was from a question. So have a great week, everyone, and we'll talk to you next time.